Hi, so today I will explain you the basic principles, the basic rules of value investing. Value investing is this kind of approach in stock purchasing that looks at the real value of the business. So we don't look at the price chart, we don't try to predict if the price is going to go up or down tomorrow or in the next hour. The whole thing is focused on the business itself. We also look at price and compare it to the real value of the business, but we don't try to predict short-term movements on the market. And there are a few rules that Warren Buffett follows, and there are also some rules from other great investors. I will also talk a little bit about the approach from Peter Lynch. He's also one of the greatest value investor. And if you look at the top 20 best investors worldwide, around 80-90% of them use this value-based approach because it's just super logical, it makes a lot of sense, it's easy to understand, and it has been working for a very, very, very long time. So Warren Buffett had a teacher called Benjamin Graham. So this kind of approach, of course, he modified it a little bit, but this kind of approach worked for the last more than 100 years. So it has been tested. Warren Buffett, he also has a lot of experience because he has been investing since he was 11 years old. And right now, he's nearly 100 years old. Okay, so let's start with his rules. The first rule is that the market is inefficient in the short term, meaning that there can be stock market crashes or there can be bubbles where the price is not really connected to the real value of the business. If we look at Amazon, nowadays the price to earnings ratio of Amazon is 100. That means if the earnings of Amazon stay the same, if you bought the whole company, you'll double your money in 100 years. So the earnings per one stock is 100 times smaller than the stock price. So we can call it kind of a bubble. Of course, maybe Amazon will continue its great growth, and in reality, you won't get double your money in 100 years because the company is growing, the earnings are growing every year, and that indicator doesn't show that. But still, it will take probably a lot of time. I don't know, 20, 30 years maybe to double your money. Of course, the market can be inefficient. The price of the stock is fully determined just by people buying and just by people selling. So if people don't look at the fundamentals, they don't compare the earnings of the company, they don't look at the business, they just speculate short term or they do trading and they only try to predict like the next day or the next hour, they can drive that price higher very quickly or lower super quickly. The fear is even stronger emotion than greed on the stock market. So if we experience some stock market crashes, they happen usually very rapidly, and it's perfectly normal for stocks to drop 50% in a week. So stocks can be very volatile. You can lose a lot of money very quickly, but they also give you better rewards. It can be called risk premium. The more risk you take in financial world usually comes with greater benefits. If you keep your money on a bank deposit, you won't earn so much as if you invest in stocks, but you also don't have the opportunity to lose so much. And risk also comes when you don't know what the hell you are doing. That's pretty obvious, I hope. You should always stay in the circle of competence. That's next law. So the market is inefficient in the short term, and that really gives us huge opportunities to buy stocks under the real value. So in times of panic, of negative sentiment, maybe something happened in the world and people are scared, they're withdrawing their money from the stock market. So a lot of people are selling and not so many people are buying. And that will drive the price lower and lower. So during those huge crashes, you can find the most opportunities. Majority of the stocks will be undervalued, meaning that the real value of the business will be higher than the current stock price. And during those times, you have to understand that it's a great opportunity that happens very rarely. So a big stock market crash that is bigger than 25% happens, I think, around once every 10 years. There are also smaller downturns that are called bear markets that can last a shorter period of time and can be smaller than that 25%, and they are more frequent. I think the market goes down 10% every 2 years. And the market, when I say the market, I mean the index. So an index, maybe you heard S&P 500 or VIX or DAX. Those are instruments that hold all of the biggest companies from certain region or country. So they can be like a reflection of a whole economy of a country, or at least few hundred biggest stocks. Like in case of S&P 500, that's 500 biggest stocks from the USA. So during those times of panic on the stock market, when you can also find a lot of negative information in the media, in reality, it's a very good time to buy cheap stocks. But those undervaluations also happens no matter what is happening on the broad market. So on the broad market, the indexes can rise, and yet you can still find single undervalued stocks. It's a difficult thing to do, but it can be done. At every time, there are like thousands of different stocks that you have access to from all over the world. So even if, 0.5% of those stocks are undervalued, you can fight them and you can have great opportunities to invest even in any time. It doesn't really matter, especially if you have smaller capital. So if you don't have millions and millions of dollars, then you can invest even in smaller companies. So you have this advantage that Warren Buffett doesn't have. Warren Buffett has so much money that he can invest only in the biggest companies in the world, and those companies are heavily analyzed, and it's very unlikely that they will be mispriced. While you have some boring companies, maybe from Poland or even from USA, that are smaller, that have a boring name, and they are doing something boring, those companies, not many people look into them, and they can give you great opportunities. So in the short term, we can benefit from the stocks being undervalued. We can look for them at any time, but during stock market crashes, there's a higher opportunity for finding them. It's very easy to find them during a huge panic on the stock market. And the panic on the stock market, usually all of the indexes are a little bit connected. So if something bad happens globally, you will have great opportunities in USA, in Europe, in Germany, in Poland, all at the same time. And sometimes, of course, like with the war in Ukraine, there was a huge drop in the price of Ukrainian stocks, but those companies face a real danger. War can destroy them, they can go bankrupt, so it's a really risky situation to invest in those places. But sometimes the fear doesn't have a reality behind it. So, for instance, in times of COVID, when there were lockdowns, the price of Facebook dropped massively. And as we know, people were locked in their homes, and actually the usage of Facebook went up. So it was a good situation for Facebook, but there was a fear in the whole market, so all of the stocks went down with Facebook. The next rule is the market is efficient in the long term. So your stock price can be below the real value, but we believe that in a few years, maybe 2, 3, or 4 years, the stock price will go to the real value of the business, and it works both ways. If you are buying something with a high price, like maybe you want to invest in this Amazon or in Tesla, that price might correct and go down to the real value of the business. And the same goes for buying undervalued businesses, so businesses where the stock price is lower than the real value. So we want to try and invest long term. Long term, Warren Buffett says that a good minimum would be 5 years, but optimum is 10 plus years. So it's a really long term thing. And when we pick a stock to buy, you don't look at the price chart, you don't think about predicting the future. What you want to focus on is just buying a great business. This is one of those laws from Warren Buffett. He looks for great businesses. And Peter Lynch, another great investor, has a very nice and simple rule to follow in order to find leads, to find some good opportunities, and maybe then do a more in-depth analysis of those companies. So what Peter Lynch suggests is that you look around you and you look in your circle of competence. So for instance, if you work with cars, if you know the automotive business, then you can look at those companies and try to evaluate them. Because for you have advantage even from the guys that work in the finance, in the banking sector, in investments, because they don't know the car companies and cars so much as you might do. So there should be sectors where you have some advantage over others, and you should look closely into them. You can also look around you and look at the products or services that you use that are just your favorite. So maybe you have your favorite type of pen or your favorite car, and it can be a good lead to look further. So if you have that good thing, let's say you have good car, and let's say that you had 100 cars, maybe you're a mechanic and you have seen that Tesla, wow, it's just the best electric vehicle, then you still have to check the financials. I have a short episode about financial indicators. It's episode 8 that will help you look at the basic things. So like comparing this price to earnings of a company. Even if the company has a great product, the stock price can be so high that you will still lose money while investing in it. And often while investing in stocks, people try to predict what the future will bring. So the standard way of thinking for people is that they say, oh, I think this technology is the future, or this company in the next 5 years will be the next Microsoft, or whatever. They say, oh, there's a war on Ukraine, so this company that produces weed or weapons will make more money, etc., etc. And that might work, but very short term. So there are many analysts who look at different stocks, etc., and they also try to predict the future. And if they can easily predict that, okay, there's a war in Ukraine, so probably the Polish companies that produce weapons will have greater earnings, they will buy that price and drive that price higher. And those predictions, those future predictions, they are not facts. They are just predictions. So they can happen or they don't have to. So there are two ways it can happen. There can be a good prediction about this real estate market, so the housing market. People can say, oh, the prices of the materials will go up in the future, so that the companies that build real estate, if the materials go up, if the price of materials go up, those companies will earn less because they will spend more on the materials. So the price of those stocks or those companies that build houses will go down. And it's just a speculation. It's so hard to predict the prices of materials like, I don't know, copper or sand or whatever is used, or bricks to build houses. And if those predictions are correct, the stock price will not go down a lot because people already predicted that. They already sold those stocks, so the stock price already went down. The market already priced that in. But if the prediction was wrong, and in reality the prices of the materials didn't go up, let's say they stayed the same, the market made a mistake. So there is a probability that market is wrong about the future expectations, so that the price will go up if the materials don't raise in prices. So in this case, the speculation, the outlook was bad. It gave you more actually potential to invest in that company, because based on future predictions, the stock price went down, and those future predictions are not facts. In other way, if we have a prediction that the price of materials will go down, the stock market for real estate developers, the prices of their stock might go up, and the future is unknown. So the materials might really drop in price, but that won't really affect the stock price so much because it's already priced. The price already went up because people anticipated it. People thought it will happen. But if it doesn't happen, then the stock price will go down. If those materials that people predicted will go down in price didn't go down in price, that stock price might fall. And investing on the basis of predicting the future It's just something that Warren Buffett doesn't do. Many people ask him what does he think about the future of economy in USA, and he always says that he doesn't know, but looking on the past performance, the USA was growing. So he can say that most probably it will continue as it used to be for the past 10, 20, 30 years. The second biggest mistake people do is that they look at the price chart, and they look at the price chart, the price was rising in the last year. That's how they invest in Bitcoin. They look at the Bitcoin, they say, oh my God, the price rose 10 times. Like, I could have earned so much money. I better buy Bitcoin. They think that because the price was going up before, it's a good time to buy. But that's not the truth. The truth is that if the price was going up, maybe the Bitcoin or the stock is heavily overpriced. You cannot really say it without looking at the fundamentals, because the stock price is not always connected to the real value of the business. In majority of the cases it is, but not always. Sometimes the stock price there can be an anomaly that is occurring very often, that a lot of stock prices are just above their real value. And sometimes it's less likely that the stock price might be below the real value, and that's a good opportunity. But Warren Buffett, he changed that way of thinking. He's not looking for underpriced assets. He's just focusing on the great companies. He's looking for competitive advantage. So he's looking for companies that have advantage from their competition. So for instance, let's look at the mobile phone companies. There are, 20, 30 of companies that produce phones, but there's only one Apple phone. So they have a unique product. One of those competitive advantage is to have a unique product. The second one is to have a unique service. And the third one is to be the lowest cost seller. So you sell something, let's say you sell chairs, and you have a competitor that also sells chairs. But your chairs are similar, the chairs are similar quality, but you can offer the lowest price. So why would anyone go to your competition and not just go to you and buy the same stuff just for a lower price? So that's the third competitive advantage. And Warren Buffett says that the competitive advantage and just a great product or service or a great business, that can be actually everything connected to the business. It can be the managers, it can be the sales team, etc., etc. It's better to buy a great business at a fair price than to buy a shitty business even at a very, very, very low price. And always, while looking at businesses and analyzing them, he stresses the importance of circle of competence, meaning that you work only in sectors that you can understand. So if you are a farmer and if you are trying to buy some technology company or pharmaceutical company, you don't know what the hell is going on. If you're a farmer, you should buy companies that do farming. You will be an expert on that, and you will have an edge. You can evaluate those companies better if you learn basic accounting and basic financial indicators. You can predict the future better than those financial bankers. So you have that edge that is connected to what you know, what you're interested in, and what is your work profession. So summing up, the market is inefficient in the short term, meaning that the price of the stock doesn't represent the real value of the business, and it can be both good for you and bad for you. Maybe the stock price is below or above the real value of the business, and that's for you to estimate through reading financial reports and doing the financial indicators kind of thing. And in the long term, you can be sure that after a few years, the price will go back to the real value of that business. When picking stocks, you have to stay in your circle of competence. So make sure that the stock you are trying to buy and analyze isn't too difficult and isn't too separate from the field that you are working or that you are interested or knowledgeable in. Try to look around you, use the Peter Lynch formula, just look at the favorite products or services that you use, and then look into companies that produce them. A great product or service is a key to a good business and a good investment. Very important, don't waste time trying to predict the future. Don't try to predict the price of oil or the price of gold. Don't try to predict how the economy will behave. Don't try to predict what Putin will do. Those things are just, you can predict them if you are president of USA. If you are not, I'm sorry, but there's just so much stuff going on in the world, and you live in times of propaganda. I'm sorry, but a lot of information that you are getting are also not true. And there are just so many factors that influence the world around us. It's just too difficult to try to predict all of that, and it's just a waste of time to try and do that. And remember to always focus on the facts. Don't think too much about the next 5 years. Look maybe at the next year. It's easier to predict the next year. And try to look at the past, because it is also certain. You know what happened. It's not a speculation if you look at the past and the present. And basing on that, you can evaluate a company and have great results. And always remember that risk comes when you don't know what the hell you are doing. And the return on your investment is highly correlated to the work you put into the analysis. If you do a long and good analysis, you can expect good results. But if you don't follow a great strategy, of you buy because of some feeling, you don't really look at the financials, and you don't really put much effort into deciding what type of stock to buy, you will most certainly lose a lot of money while investing in the stock market. And it's also very, very important to understand behavioral finance, because the psychology is also heavily connected to the world of finance. A lot of even mechanisms that are connected to gambling can be seen in finance. And especially during stock market crashes, etc., there are many mechanisms, psychological mechanisms, that will make it difficult for you to make a sound and logical decisions that is not based on your emotions or critical thinking errors. So yeah, look for a great company with a great product or service that hopefully has a unique product or a unique service, or is a low-cost seller of that product or service. Remember to always look at the financials and test the products. Make sure that what the company is producing is of high quality, if the management of the company is good, and if the price of the stock is not in a big bubble. Okay, I hope that those basic lessons will help you in decision making in the future, and I hope that the strategy of Warren Buffett will bring you great benefits. I really like that man. I think he's really intelligent and smart, and he has just so much experience in the stock market investing, and that strategy has been tested for such a long time that I'm sure it works. It just takes a lot of time to do a good analysis, and if you follow those rules, I can ensure that with the right analysis, you'll have great returns on the stock market. Thank you for listening, and I hope to see you in the next episode. Bye bye.